Yeah. So look, and it comes down to, your belief and your mindset. Like, there's books like Think and Grow Rich, what your mind can conceive, you can achieve. So a lot of people have a belief, Dylan, that they need to start small or a house hack or do 2 units, 4 units, 6 units and work your way up. And that is one way to start. The challenge is it's just slower and painful. My first investment property ever was not a single family home or a duplex or a fourplex. It was a 32-unit building.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. Today's guest, Brad Sumrok, is the founder of Sumrok Multifamily and has over 23 years of experience investing and over 1.2 billion in assets under management. He also helps others build wealth through real estate, and he's been featured several times on Good Morning Texas. You can find him across social media, including his Instagram at Brad Sumrok, or on his website, bradsumrok.com. Brad, thanks for taking the time today.
Hey, I'm glad to be here, Dylan. Thanks for having me.
Now, when we talk about multifamily investing, I know this personally. There's a lot of investors specifically from the single family space that in Texas in particular, right, where you're based out of and where I'm licensed, it's harder and harder to fix and flip homes. And I know that may be coming back, but over the last couple of years, I've seen many people pivot into new areas. I've seen new construction. I've seen RV parks. I've seen mobile homes. I've also seen a lot of people get into the multifamily space. I want to ask you really at the top of the show, for folks who are looking to get started in multifamily, what would be your feedback for those folks, coming from other asset classes, or this may be their first investment?
Look, if you're already investing in real estate, any type of real estate, and you understand the benefits of things like cash flow, appreciation, especially like value add appreciation, tax savings, depreciation, like the logical next step for you if you want to scale is to move into bigger assets. And that's one of the things I love about multifamily. So like, I would say at least half of my most successful clients, the people that I coach and mentor, were previously doing like single family rentals or flipping. And then they saw that logical next step to scale into multifamily and be like a true business owner, like buying a building in a syndication that's professionally managed, where you're not having to collect rents or do all the work yourself. Robert Kiyosaki talks about the cash flow quadrant with ESBI, employee, self-employed, business owner, or investor. So for people that want to transition from self-employed to being a true business owner and investor, multifamily is perfect.
Now, when we talk about getting into this space, a lot of people will talk about house hacking, and getting, a small multifamily, duplex, triplex, quadplex. But then on the flip side, you have people saying, you might as well, if you're going to do 2 or 3, get 50, and you have some people saying even larger than that. Is there a specific specific number of doors that you would tell folks who are looking at multifamily to get started with?
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
Yeah. So look, and it comes down to, your belief and your mindset. Like, there's books like Think and Grow Rich, what your mind can conceive, you can achieve. So a lot of people have a belief, Dylan, that they need to start small or a house hack or do 2 units, 4 units, 6 units and work your way up. And that is one way to start. The challenge is it's just slower and painful. My first investment property ever was not a single family home or a duplex or a fourplex. It was a 32 unit building. And when I started the way that I now help other people with, where I went to a 2-day weekend seminar and I bought the mentoring program. And that was back in 2001. And by 2002, I had 32 unit apartment building. And my mentor at that time said, Brad, buy as many doors as you can under one roof. And for me, it was 32 units. And so I put the 20% down. I saved my money for 14 years when I was in corporate America. So I had the ability to come up with a down payment and I bought those units. The problem was after that, I ran out of money. And so the next deal was a syndication where I found the great deal, but I didn't have the money myself. But because I was out there going to networking events and telling my story and getting to meet people, I had a line of people that would say things like, hey, if you find a deal, I'll invest with you. So, to me, if you want to do your own deal with your own money, I would give them the same advice, Dylan. Buy as many doors as you can with your own money on one lot. So whether that's 10, 20, 30 units, 8 units. Right. However, if you can get 50 units or more, now you're buying into the realm of professional management. So that's sort of my cutoff is 50 units and more. And you'd say, well, Brad, I don't have the money to buy 50 units. Let's just take a nice, safe, clean, stabilized C-class property in Dallas for $100,000 a unit, or even $80,000 a unit times 50 units. That's $4 million. And then you need 30% down in today's market, so that's $1.2 million. Well,
right.
There's not a lot of people that have that. So then they say, hey, Brad, that's great, but how am I going to do 50 units? And that's where syndication comes in. So imagine you have 25 or 50 grand to put into a deal. But now if you have a clear vision and you could communicate that vision and you could go to enough networking events and build up an investor database, you could raise the money and get into a bigger deal and have professional management. So hopefully that answered your question. 50 units or more could get you into the professional management game. My first 32 units, I had to self-manage. I have a student right now that wants to buy 8 to 12 units. And I told him, and he knows, like he's going to need to do a lot of it himself. The 12 units doesn't have enough cash flow to pay for a professional maintenance person, a professional property manager, a professional bookkeeper, a professional leasing agent. Like you don't have that.
When we talk about 50 units and up, right? And then you're able to have more assistance, right? Because there's more cash flow there. Are most folks who are looking at deals that size, are they syndicators, or are they coming from a realm of where, hey, we've kind of scaled up and now we have, maybe a couple of partners and we're buying deals that are, let's say, 50 units. What's the makeup of someone who buys, let's say, a 50-unit apartment
Well,
complex?
I don't know the exact makeup, but I would say more than 50% are syndicators.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
And one of the reasons is, so like I've been doing seminars and mentoring for 16 years and investing for 24 years now. One of the reasons is when people learn, let's say like a guy like me starts out and he or she has a job and making 80, 100, 150 a year, and they may have 100, 200,000 to invest. Well, with, let's just say 100,000, with 100,000, you could buy a fourplex.
Right.
And now you just bought yourself a job, you know, or with 100,000, you could buy a 50, 60, 80, 100 unit deal if you have an investor database. And
Now,
you could take 20% of the deal, like, because, the general partner or the lead syndicator, they're going to find the deal, analyze the deal, put the team together. If you oversee the deal, oversee the rehab, because you're doing all the work, you're the active investor and the other investors are passive investors. You can negotiate whatever the market will bear. But what most people are doing out there is the syndicator or the GP team, they're taking, 15, 20, 25% of the deal.
when I want to pivot a bit here, Brad, when we talk about what good looks like as far as Texas multifamily, and we were talking a little bit before hopping on the podcast here, you really had all these black swan events happen. Raising rates so many times over the last 5 years, and then all this multifamily being built, and then costs going up and rents somewhat stabilizing even in major metros like Austin, Texas. But that aside, like here on out, when you're looking at value add multifamily, what does good look like? What types of deals are you looking at to acquire?
Yeah. So when we look at projected returns, and this is a whole nother conversation for maybe another show, right? Because everybody's got conservative underwriting, right? But it's not really conservative. But if you just look at a underwriting model that's built on sound assumptions, so what does a good deal look like is, well, and I'm talking about returns at the deal level, not at the, you know, like the GP level or taking splits or fees into account. But a deal should double investors' money in 5 years, 4 to 5 years. If somebody would invest 100,000, they should have 200. If you buy a $4 million deal and put $1 million down, you should have 2 million in equity in 5 years. So I look at that, right, through a value add model. And part of that return is going to be cash flow. And so there should be cash flow. Now, based on today's market, what I'm seeing in terms of cash on cash returns with good deals is like mid single digits, or mid to high single digits. So 6 to 8% cash flow with an appreciation component and a depreciation component. And you may have heard of the big, beautiful bill that brought back 100% bonus depreciation. So I look for all three. I look for, is there cash flow? What is the projected value after I buy the deal and implement my value add business model? And of course, you got to put in you know, things like rent growth and reversion cap rate. And these numbers need to be like super conservative. Like, don't go too aggressive on those things. But if the deal cash flows and has a value creation component and a tax savings component, that's a good deal for me. Now, typically, I'm finding those deals right now in like the older properties,
Yeah.
the 1970s, 1980s properties. I'm not seeing those types of returns in the newer deals.
I want to ask you specifically about new multifamily. I've heard this from a number of syndicators who've told me that, building new multifamily isn't underwriting. I don't particularly understand why that would be, because I think about Texas, I feel like I'm seeing new multifamilies developments everywhere. So I'm thinking, well, if it's not penciling, what's up with all the new multifamily?
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Well, that's the problem. Why it's not underwriting is that when there's more supply than demand, like in certain markets, like in Dallas and in Austin and in Houston, and it's not across the board. Like if you go to these, workforce housing neighborhoods like Garland or Irving, you're not seeing a lot of new supply. And that's why I like to buy in these areas. I buy buildings in these working to middle class demographic neighborhoods because there's nothing being built there and nothing scheduled to be built there. And so where's the working class family going to live? Right. But when you go to uptown, for example, or downtown or over by the Ritz-Carlton Hotel or, Knox Henderson, there's an overwhelming number of new units coming
Yeah.
online. And when they come online, they have to lease them up. And when they lease them up, they're going to offer move-in specials, 6 weeks of free rent on a 12-month lease. And so imagine I have a 2018 built property next to a new property coming online where they're trying to lease it up. And they got newer units, newer gym, newer swimming pool, sauna, jacuzzi. And my property that was built 8 years ago doesn't have those things. And our rents are almost the same.
Yeah.
So where are they going to get their tenants? They're going to get them from my building. Now I got to offer lower rents, concessions just to renew my leases, or they're going to move across the street where the new property is opened up. And you could buy right now for less than you could build. So you may have heard people talking about, well, my acquisition basis is good. So why would I, back in 2020, when multifamily pricing was at the peak, developers had a good argument. They were like, hey, I could build this Class A property for less than people were paying for an existing property.
Wow. Yeah.
And so people were doing that. They were getting into development. But the problem with development, Dylan, is it takes 2 to 3 years for something to come online. So you have a set of data in front of you that you're evaluating. And how do you know what the market is going to be like
You have
in
no
3
idea.
years from now? Where is inflation? Who's going to be the president? What policies is going to be there? Who's going to control the House and the Senate? Are we going to be bombing Iran? Is what's what's happening?
Yeah.
Are we going to get back into the climate accord, or are we going to stay withdrawn from it? Like, you can't predict and model these things.
There's that huge element of risk there, which is the time it takes to get the deal online could be entirely different, right? And I think when people think about especially acquisition, especially folks who are coming from the single family space, that type of delay seems foreign, because you go in, that's just a brand new concept. This idea of, I'm underwriting this right now, but this could mean next to nothing when this deal finally does get live. We actually
Yeah. I was
I
going
was
to say, this is why development is far more risky than buying an existing apartment building. Like, I've never developed anything, and I buy existing buildings for 24 years now.
Yeah, I think that's certainly the sentiment that I've heard from lots of people in this space. I've heard, not doing a lot of or any, new construction, and then also I've heard a lot of people talking about being on the sidelines, really just waiting to see where the dust settles with everything. And I think things are coming back to some semblance of normalcy. But we will certainly see here in the coming months. We are coming up on time here, though, Brad. Any new projects that you're working on, and then also, what's the best way for our audience to reach out to your team?
Yeah. So, I mean, look, I'm working on 2 deals right now in Dallas. They're both built in the one's built in the 60s, one's built in the 70s, and they fit that profile of a good deal, double investors' money, and have high single-digit cash flow. So these deals should close in the first quarter of 2026. I'm also doing an apartment investor event, which you know that I do these, and I'm going to do these every quarter in Dallas. And my next one is March 28th and 29th. And how people reach me. Well, I think you said that in the beginning. Instagram, LinkedIn, Facebook. I do my own social. So just DM me at Brad Sumrok, Sumrok. No C in my last name.
Brad, thank you so much for coming on the show. Thanks for taking the time today.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.